Hello again, everybody. Well, he's back. My good buddy Brandon Mallinckrodt, a fellow certified financial planner. We call it CFP for short, among good friends, and obviously a team member here at One Private Wealth. How you doing, buddy?
I'm doing good. How are you doing?
I'm good. Summer good?
Summer's going well. I heard that there was a race that you did over the weekend.
Oh, stop. I actually did 3 sprint triathlons this summer, which I haven't done that many in a number of years, and they went pretty well. The old guy's still getting after it.
I was going to say, he definitely did well when I see new medals coming in the office.
Yeah, well. And one of the things, as an aside, and Tom hates this, our other partner, Tom Cordes, as you know, the tradition, it's been this way for 25 years. Whenever I get a medal, I come in early that Monday morning and I hang it over his computer. And what he thought was cute in the early days, he just gets really annoyed. He's like, would you just stop it? It's like, hey, something to shoot for, right? The old guy, get out there.
I was going to say, since we've been together, I still find amusement in it. So, keep going.
Absolutely. Well, I thank you for coming on. And this is what we're going to talk about here. Brandon is our resident expert on this thing that we call the Big Beautiful Bill. And we talked about this the other day, which is interesting. Most of these bills that come through Congress and that a president signs usually have some official name, like House Resolution 423 to bring back Prosperity in America Act or something.
Yes.
When we hear Big Beautiful Bill, that's actually the official name of this thing.
I know, and you and I both got a laugh out of it too, thinking it was just a tongue twister and just a marketing PR
Trump
thing.
Right?
Yes, and turned out that it's actually the name of the bill.
Yeah, One Big Beautiful Bill Act. OBBBA is the actual official title of it. But there are a lot of moving parts, a lot of components here. And so Brandon is our resident expert. He's been talking to a lot of our client CPAs and clients themselves to try to navigate this a little bit. And so we're going to use a hypothetical example that we'll talk about some of the more important parts of deductions. But before we do, I think it's important that people understand the difference between a deduction on their taxes and a credit. Help us with that.
Yeah, so I think a lot of times people get confused thinking that a deduction is going to be a dollar for dollar reduction in what their tax bill actually is. But when we look at it, a tax credit is when you get a dollar for dollar reduction in your tax bill, whereas a tax deduction goes against your total taxable income that you have, which is then utilized for the amount of taxes that you will pay that year.
So like your 401k, that's a deduction that you're putting money into.
Yeah. Yes. Versus getting a tax credit from the government, which would be, in essence, a refund that you would apply to your tax bill for that year.
Right. And there are a lot of components of this Big Beautiful Bill. Some are credits, some are deductions, and we'll go through a couple of them. But before we do, I need to give this little legal disclaimer here. We are not tax professionals. We are not CPAs. We can give you some information. We can tell you how maybe they may or may not apply to the average taxpayer. But when it's all said and done, people really need to go to their CPAs where they can get their taxes done and get proper advice. So with that said, Brandon, why don't you take us through, I think, a couple of things that we're going to talk about here, like standard deduction, senior deduction. So I'll give you the table here.
Yes. So there have been a couple additions to what would be the standard deduction that we see now for individual tax filers, also for couples that are filing their taxes. So the standard deduction has now become increased permanently at $15,750 for a single filer, and then $31,500 for a couple filing jointly. So that was something that has been increased, and it's nice to have that now as the permanent baseline for individuals, and that will be indexed for inflation each year, so we will see a continual rise in that over time.
Now, I'm not 65, but I'm getting close. I hear it singing in my ear. It's right on the horizon. But that's an important age because of the senior deductions and even elderly deductions. So explain that.
Yes. So historically, we've had this elderly deduction. For singles, they were able to receive a $2,000 additional deduction on top of the standard deduction. Now what we have added to that is the couples get to receive, for the elderly deduction, they will receive $3,200. But in addition to that, we have now added the senior deduction, which is $6,000 for individuals and then $12,000 for couples. So we keep stacking these deductions on top of each other, increasing them every single year now in this new bill, which just reduces the taxable income for individuals and also couples.
Yeah, so when you add that together, here's a slide right now that shows you that's some pretty good deductions there.
Yes. So when you add up all of those, so the standard deduction, you also add in the senior deduction along with the elderly deduction, you are looking at right around $46,700 as the standard now deduction for those people who are filing as married filing jointly and are over 65.
Wonderful. So again, contact your CPA to talk about this. And it wouldn't be a bad idea, instead of waiting till April 14th of next year, you might want to have that discussion even here this year. Now, let's quickly move on to talk about a couple of other things that we've gotten a lot of questions about. We hear this SALT thing, state and local taxes. That's a big thing. So I'll have you address that in just a second. But the other thing, too, is charitable deductions. A lot of people lamented the fact that a number of years ago in the last big tax reform that we had, the standard deduction, great, it went way, way up, but people lost the ability to deduct those contributions. Well, in this big, beautiful bill, there's a little bit of that came back, if you would explain.
Yeah, so typically as financial planners, we work with clients who have large income and they want to offset that by being charitably inclined. So we'll utilize donor advised funds. But for a lot of people, they didn't have that highly appreciated stock or didn't want to make that high of a deduction or contribution to a charity. And so they weren't able to access that because the standard deduction was so high. So what we have seen now in this new bill is that even if you take the standard deduction, you can make charitable contributions of $1,000 for singles or $2,000 for married couples and still take that as an above the line deduction against your income taxes.
And then the SALT thing, explain that.
So the SALT, which was the state and local tax, that was set at right at $10,000 for previous years for filing tax returns. And we saw that a lot of people who lived in high rent districts were unable to deduct all of those property taxes. So in this new bill, they've increased that to $40,000, which is going to be very beneficial for those people who have high property taxes in these high property tax states.
Yeah, wonderful. Well stated. Appreciate that. So I talked about a hypothetical example. Brandon put together one. What are their names? Robert and Susan. Very good old-fashioned American names. 66 and 67, the Carters. Take our viewers through an example utilizing some of the things that you're talking about.
Yeah, so what we wanted to do was look at a couple who falls into the categories of being able to take all of the deductions that we mentioned earlier. So they're over 65, they would qualify for the elderly deduction, also the senior deduction, then they'll also be able to get the standard deduction. So let's say that they're not going to itemize. So looking at that, we had mentioned earlier, all of those deductions put together takes their taxable income down $46,700. So in the example that we're going to look at today, we're going to show that their adjusted gross income was $142,000. That coming from many different sources, whether it be pensions, part-time income, Social Security, or just capital gains that they might have received, interest and dividends as well. So once we take in all of those deductions that we mentioned earlier, it takes their taxable income down from $142,000 down to $95,300, which is kind of a main point that we should address there because they were able to keep their income now in the 12% bracket. So before they would have squarely been in the 22% bracket, having to pay income tax on roughly $45,000 to $50,000 at 22%. Now with these new additions for these added deductions, their income has now dropped down substantially. They're going to pay income tax on only $95,000, and it's going to save them a substantial amount of income tax that they'll have to pay.
And to your point, that's one of the things that we really, any good advisory team, is more active with financial planning in the process when it comes to taxes with brackets, right? Where you say, okay, we could do a Roth conversion. we could do this kind of investing. Oh, your capital gains are a little higher this year. Oh, you might not want to sell that this year because that's going to put you into the next bracket. And if you're of a certain age, that can affect Medicare premiums.
Correct.
That can affect so many other things. So this is a big topic. We're not going to get into that here. It's kind of a side topic as Brandon's talking about tax brackets and keeping you within a certain limit to fill up that bucket. So something that's very, very important. All right, we've thrown a lot of information out at you, and we're just barely scratching the surface. But I want to end with this question for you, because you have been the guy, and you've talked to CPAs about this. You've talked to clients about that. This, like I said, Brandon's our resident expert in everything related to this big, beautiful bill. As you think back of these conversations with people, what do you think might be the most misunderstood or the one that is the most confusing to people based on what they've been hearing?
Yeah, so again, people hear information all the time from many different sources. And so you have to take some of the sources that you're receiving your information from with a grain of salt. And CPAs, also clients, had heard that they were not going to get taxed on their Social Security benefits. So a lot of times people were asking, should we adjust the amount that we have withheld from our Social Security checks? Because if they're not going to get taxed, why would we pay taxes on that?
Right.
So that was initially pitched in the original bill here that we now got published and passed in July. And people thought they weren't going to have to pay tax on Social Security. Well, that wasn't the truth. What actually happened was they decided they were going to increase these deductions, which would eliminate the majority of the income that people receive from their Social Security. Typical person is going to receive anywhere between $1,600 and $1,800 a month in Social Security benefits. So if you look at that from the single side of things, which we discussed earlier, or if you look at it from the couple side, so married filing jointly, the majority of the Social Security benefits they'll be utilized by that standard deduction.
Right.
So if you're only getting taxed on 85% of your Social Security benefits, if you're in one of those higher income brackets, then now that standard deduction is utilized against those Social Security income, and you're really not paying tax on the Social Security. So they were telling you you're not going to pay tax on Social Security, or it's not going to get taxed, but really it was just a utilization of the deduction versus the income.
It's the way that you word it. It's one of these political games to try to sell it. Now, this isn't a bad thing. We want to be clear, but when you start to do your taxes, I think a lot of people are going to be surprised if they haven't looked at this. Oh, I thought we didn't pay any taxes on Social Security. Well, depends, first of all, how much your Social Security is, where you are in standard deduction. So I think that may come as a bit of a surprise. But for the most part, this is a good bill, wouldn't you say?
I think it's a great opportunity for people to do a lot of planning. I think there's opportunities for you to pull income now into these next 3 years where these higher deductions are going to be in place. I think you can be strategic with doing some other more sophisticated planning opportunities, which we can discuss in a later podcast. But I just think there's
You're inviting yourself back? Is that what you're saying?
I am. You know, this seat really likes me sitting in it. So, so I think that there's lots of planning opportunities out there. So I think you should work with your financial advisors to take advantage of all these opportunities over the next 3-4 years. The other thing that we had talked about earlier off camera was the increase in the estate tax.
Yes.
So the estate tax exemption now is set at $15 million for individuals and $30 million for couples. So we were worried about that sunsetting at the end of this year and going back down to a lower amount. Now with that being the permanent exemption amount, I think we're in the clear to make some new advances or new strategies out there as well for clients too.
That's huge. We've had so many conversations with clients. Hey, should I get a trust in the first place, or should I update it? Well, you should always update wills and trusts, but well, let's see kind of how this thing plays out, because if they let the lifetime gift or the estate tax come all the way down to like 2 or 3 million. Right. But as you said, this is permanent. It's 15 million individual, 30 million per couple now protected, which I think covers most American couples. That's my guess.
I would say yes. There's many people who are covered by this new bill that was put in place, and I think that the majority of people are going to be happy with the bill and will find some opportunities to make some adjustments that will be beneficial to them from an overall lifetime tax perspective.
Okay, wonderful. Buddy, I appreciate it.
Glad to be back.
You're the man. All right. I hope this helps, folks. Please, if you have any questions, by the way, anything related, we can't give tax advice, but feel free to put something in the comment below and one of us will get back to you on that. We appreciate you tuning us in. If you haven't done so already, hit that subscribe button. I'll be back to talk more about finances and economics and investments on another edition of the Simon Says podcast. Take care.